if you took our top 7 indicators that this market looks shaky or should be not trusted or at least looked at with a jaundiced eye, the VIX behaving the way it is certainly got our attention. It's not it's not flashing red, but it is certainly flashing yellow.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back. Welcome to another edition of the Daily Dots. And this isn't just Daily Dots. I mean, this is the longer, right? This is the longer of the show. This is the hour-long weekly show where we try to combine all the interesting things that went on during the week, but not rehash them because hopefully we've addressed those things during the week. But just, some longer form topics, usually mix in an interview. We had an interview that came out, what do we do? Should be out today with my old buddy, Rudy Havenstein. It's not his real name, but that's the persona on Twitter. And he is effectively the grandfather of central banking Twitter. So if you get frustrated with the Federal Reserve and you want to know what they're really up to and you want to hear somebody screaming at them to get off their lawn, and I say that with the utmost respect and affection. It's actually how Rudy and I came to know each other, just because if you listen to the interview that I did with him, which I'm biased, but I think it's really good. And if you wonder why guys like us don't like the Fed, I think that interview is going to be a pretty good primer on the topic. And then I'm excited because I've got a buddy, an old friend of mine, Tobias Carlisle, author of several investing books, Deep Value. Now I'm blanking out on his other books. Anyway, he's got a new book out. And I call him the Viceroy of Value. This guy's done more work and more studying on value stocks and value investors than anybody I know. Very sharp guy. And as a matter of fact, I was the first investor into his ETF, his fund, ZIG. Anyway, great guy. And he's Australian. I always like Australians. I don't know why. I mean, I envy the accent. And, if they're from the land of down under, I mean, it's so interesting, right? Kangaroos and giant spiders. And my wife wouldn't like it. She hates spiders. But, no, I've always loved Australians. Anyway, Tobias is a dear friend. And I don't know if there's anybody smarter than him or more knowledgeable about the subject of value investing. So we're going to have him on Monday. So I promised you it was slow on the come, but more of those interviews are coming. And I'm excited to hear what he thinks about this market. And then I want to hear about his new book because it sounds fascinating. I'm not going to butcher it. We'll let him explain it on Monday, but that should be fun. So anyway, getting to markets today, we'll kind of run through the things. And there's a couple of things that I want to talk about at greater length. But we are sitting here about 5 minutes from the close. Market's effectively flat last time I looked, a little bit up on the day, not a whole lot going on. Let's see here. Where are we at? So S&P down 0.3. Okay, barely. So you're flat on the day. Dow's up 0.51. I'm not really sure what's rallying on the Dow. NASDAQ down 0.3. Gold up another 1.1%. VIX is down a little bit, was up a little bit yesterday. We're keeping a really tight eye on the VIX. You're going to keep me talking about that. And I've said it before, but I'll say it again. Especially when the VIX is down at this level, because just for those of you that don't know, 15 is seen as kind of the basement for the VIX. Now, it goes lower than that. But when you got a VIX at 15, insurance is cheap. Put options are cheap. The VIX is cheap. That's relatively a very good price for insurance. And when you're in a bull market, or not even necessarily a bull market, but when you're in a big upswing, okay, when the market is up, you expect to see the VIX getting pounded, going below 15. I think the VIX is positive on the week, and so is the market. And I've said a million times, there are no fail-proof signs. But that is if I was going to sit there and say, what are our top 7 indicators that market turbulence could be on the way? When I see the VIX behaving, it hasn't had a pop. What usually catches my attention, let's say you got a day where the S&P is up 0.3, 0.4, something like that, and the VIX is up 7%. I'm buying the VIX every time I see that. Okay. For whatever reason, that has been a very good indicator for us that it's, the VIX is about to pop, markets are about ready to get smacked down. Now, you guys hear me talking about the VIX. I want to make this very clear, okay? Do not use the VIX in trading unless you understand it very well, okay? And the reason why I say that is if you buy any type of VIX ETF and leave it in your portfolio for a period of time, if you leave it in long enough, it will go to zero no matter what happens in the market. You will lose 100% of your money. And the reason why is because the VIX is only priced out in futures markets for 6 months. Okay, so that means every month those funds have to be rolling contracts in and out, right? And usually the VIX averages somewhere between 15 to 20, right? So if you buy the fund when the VIX is between 15 and 20, and if you sell the fund when the VIX is still 15 and 20, you're going to take a loss. Why? Because the internal contracts expired. Right? So you were losing that value every single month. And there aren't exacts to this, but if memory serves me, I think on average, if the VIX stayed flat, didn't move up or down, and you were you're in one of those ETFs, you're going to bleed somewhere between 5 to 7% a month. It's called theta decay. The time value of that option is eroding right in front of you. Okay, so I'm not going to sit here and talk about the VIX. I just want to offer that up. You hear me talk about it. We talk about it as a hedge. I do not recommend hedging unless you're a professional investor, first of all, because it's not shorting, because you're not short the market, but it's the same dynamics. And just trust me. If you don't know, and even guys that know, look, there have been times where COVID was a perfect example of this. You guys know me. I'm going to be open all the time. First bout of COVID, we thought the market was going to get rocked. We came into it loaded up on treasuries and the VIX. Both went through the roof. We got through COVID. Market was down 36.5. I think the fund I was running, I'm the manager of, I think we were down, I want to say around 8. Or maybe it was 9. Anyway, it was single digits. Let's say somewhere between 8 and 9.9, somewhere in there. And one of the biggest reasons for that were those hedges. Okay. The flip side is we didn't get deployed back in the market quick enough. So even though we weathered that storm beautifully and outperformed the market considerably, we ended up underperforming that year overall. Now, does that mean we don't use? Oh, wait, guys. Okay, hold on. I was looking at outdated market info. Okay, so I gave you bad market reads. I just saw this. Okay, hold on. So S&P finished, geez, it's just everything I look at. It's not a healthy market. The swings over, oh, geez. Man, in the last, if I'm looking at this correctly, man, the last 10 minutes were just all over the place. Anyway, got as high as 0.4, as low as 0.3 on the S&P, finished the day right flat. So the numbers I gave you ended up being right. Sorry. So anyway, now we still do that knowing, look, hedges overall, over the long run, are going to chew into upside. Just take it as a rule. Okay. But when deployed correctly, they can prevent major loss. And when you do that, it's science and art. But when you do that, what makes the biggest impact on long-term returns, and I've said this a million times, but what makes the biggest impact on long-term returns is the hits you take in the down markets. Okay, what I would suggest is start hedging with cash before you use other things like that. Get that experience, because it's kind of the same, right? If you're wrong, you don't lose money, but that money doesn't make any. And I think it's a good way to do it. And I think you can even simulate it. Use a dollar ETF, right? So you're betting on the dollar going up. That can be a hedge because usually when markets get rocked, the dollar goes up usually. But it'll kind of get you that feel. And the reason you don't want VIX is you get in a hot market and you get something like the VIX on your position, you can lose 25% a day. If you're using the options and the futures outright, you can lose more. So anyway, just caution on that front.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate and actual performance may differ.
Getting back to what I was saying, if you took our top 7 indicators that this market looks shaky or should be not trusted or at least looked at with a jaundiced eye, the VIX behaving the way it is certainly got our attention. It's not it's not flashing red, but it is certainly flashing yellow. Let's see on the individual securities on the day. We've got Ford up big. I'll give you another bit of truth here. Even for value investors, even for people looking for really good deals, be very careful about the U.S. automobile industry. I will be shocked if it does not have a really tough time over the next 10 years. And I'm not talking so much here about domestic purchases. I'm talking internationally. It blows my mind a little bit how underplayed the threat of Chinese automobiles are. They are coming and they are coming fast and they've got really good stuff for really good prices. So I would not want to, I'll tell you what, I would not want to be the CEO. Well, I mean, depending on how much they got paid, maybe for a couple of years, but I would not want to be the CEO of a U.S. automobile manufacturer right now. That's just, it's not talk about having a reticle on your back. Not where I'd want to be. Much rather prefer to be a CEO of a gold mining company at present. What do we got else in the market? Let's see where we're at with rates here on the day. Let's see, 5-year bond, we're right at 3.7, 10 years at 4.11, 30 years at 4.71. That's a decent pullback there. I haven't been looking at that for probably about a week because Chase is always on it. Oh yes, and I should have said, I am not joined as always by the Brain Trust himself. He is still out on his little bit of a break here with the fam. But Palantir getting routed today. Claims they have security flaws after stock falls. Who knows if it's real? I'll reiterate it to you again. This is the problem with stocks that are trading that expensive, even a company that has got amazing stuff like Palantir. And guys, I could be wrong. I've been wrong on Palantir. Well, I wasn't wrong on Palantir. I just thought it was too expensive at 30 times revenue, and so I sold it. And apparently the market disagreed. But, you know, effectively a rumor going around and the stock pairs off almost 8%. You know, that's the problem with stuff priced that expensively. I mean, if anything shifts whatsoever, it is going to get absolutely hammered. Now, let me get into what I really want to talk about today. And I'm not sure why this just popped up all of a sudden, but I'm sitting there, I'm seeing all this back and forth with so many people, Jim Cramer's of the world, you know, let's see. I mean, everybody has piped in on this one. People on CNBC have been all over it. A lot of back and forth arguing. AI bubble. Is it a bubble? Is it this? Is it that? I'm looking at my screen right now. News story pops up. Bezos says AI bubble is real, but so is the technology. So I want to get into a broader discussion on what a bubble is because I've heard a lot of people talking about this. And that's also going to whipsaw into a conversation about what a value stock is because I hear a lot of talk about that. And it should be no surprise to anybody considering the environment we live in and these markets and how they've been juiced by the Fed and government spending and all the stuff that we know. It should be no surprise that there's a lot of people talking about, is this a bubble? Is it not a bubble? When you see mega cap stocks trading at 25 to 30 times revenue, 100% of times in the past, that constitutes a bubble. Jim Cramer's arguing it's not a bubble. Bezos says it is, but the tech is real. So what's the truth? Well, let's first define what a bubble is. Okay, so that word gets thrown around all the time. And I think it gets used incorrectly by the people that are arguing it's a bubble. I think it gets used incorrectly by the people that are arguing it's not. So, to me, what a bubble is, truthfully, and you can have a bubble in individual stocks, but it works the same. It's where a security's valuation, meaning the price it's trading at, whether we're looking at price to sales, and price to sales is just basically you're looking at the price of the company. So the market cap of the company, so the value of all of its shares put together, and you're dividing that by its revenue, right? So you're saying how many multiples of its revenue does the company trade at? So if you've got a company that's got a market capitalization, so the value of all of its stock when you combine it is $25 billion, and the company does $1 billion of revenue a year, not profit, revenue. And the reason I think revenue is almost a better test of bubbles, especially when it comes to, looking at individual stocks or valuing individual stocks. The reason why I think price to sales is my favorite metric, because there is so much nonsense that can go into earnings. We can have adjusted earnings. If you remember the company WeWork, they had something called community adjusted earnings. I still don't even know what that is. There's all kinds of games. Stock-based compensation can overinflate your earnings. Buying back stock can change the way the earnings per share look. There's so many different ways. But price to revenue, it just is what it is. It's easier to fudge profit than it is revenue. There's a lot of legal things that you can do to juice profits. There's not many legal things you can do to juice revenues. Now, you can realize them earlier than you should and things like that, but I'm just saying it's more. So just think about it, right? Think about how crazy that is, right? Because if I buy a company for $25 billion, okay, so if we don't think about it like a stock, think about it as a private company. We go out and buy this company for $25 billion. It's doing $1 billion revenue. And let's say out of that $1 billion, let's even give it credit. Let's say it's making a profit. Okay, let's say it's doing $100 million a year. Remember, the revenue is not what pays you back as an investor. And remember, until you get your $25 billion back, you haven't made a profit. Now, you don't have to get all of your $25 billion back via profit, right? Maybe it's a combination of you selling the company plus the profit you made while you owned it, right? That can add up to a profit. But just think about it. Think about it in terms of almost all of us know somebody that owns their own business. You got a friend and he goes, "Hey, do you want to buy a piece of my company?" And you go, "Well, maybe. You seem like you're doing pretty good. You just got your wife a new Cadillac Escalade." "Yeah, let me look at the financials." And you see he did $1 million in revenue and did $300,000 worth of profit. And you're like, "Hey," and it's growing, right? He did $800,000 of revenue last year. This year it's $1 million. So he's growing at 25% a year. Looks pretty good. And then you ask him, "Well, what do you want for it?" And he goes, "Well, I was thinking you could take a 50% stake for $12.5 million bucks." So what that means is you're paying 25 times revenue. Okay, now why we say this is so expensive. Now, again, it's not a perfect comp because it's easy to sell a stock and recoup some of that original investment. But reality is still reality. This, math is still math. So what you're thinking when you look at that price that your buddy wants for half of his company, you're sitting there going, "Okay, so that means I'd get half the profit. So that'd be about 150 grand a year." Whew. And even if we hold that 25% growth rate, it's going to take a long time for me to make my $12.5 million back. In the meantime, I hope the company keeps growing because I don't have enough time. I can't afford to sit in this investment for 15 years. I needed to pay. I'm planning on retiring in 7. I need this to pay me a profit within that time. And remember, if something bad happens to the business, that opportunity of selling it to recoup some of my money may get very restricted, very truncated, right? That price could go down drastically. while I'm owning it, depending on what happens to the underlying company. So when you see companies trading at these valuations, 100% of the time in the past, it has been emblematic of a bubble. And the reason why is, think about that, right? If I am paying 25 or 30 times revenue for a company, I'm pricing so much good stuff in. And that's what we were talking about earlier this week. Tesla announced a surprisingly good quarter. The stock's down 6% since. Why? Because it was pricing in insane returns. And they're not coming. People say, this is so stupid. Tesla's being manipulated. Look at the news came out. And you're like sitting there going, guys, it is an automobile manufacturer trading at 260 times earnings. What do you expect? They don't need a 7% beat. They need a 50% beat. They need to show revenues growing at 30 to 40% a year. They need to see margins inflecting higher. And they need to be doing all this other stuff in FSD and robots and all that kind of stuff to even come close to sniffing that valuation. So getting back to what is a bubble? A bubble to me is any sustained period of time of something other than financial fact or financial data or financial information driving a stock. Maybe it's just, maybe it's a Reddit deal, right? Maybe it's Wall Street bets. Maybe it's a chat room driving this, whatever. The point is that the price continues to go up, usually pretty aggressively, based on something other than the reality on the ground. So think of the bubble. Think of a bubble is the space between price and actual value. And that's kind of a good way to look at it, right? Because we talk about bubbles bursting. What happens when a bubble bursts? That space between price and value closes. So that now they're going to come in different shapes and sizes. They can all have different causes. Bubbles are frequent occurrences in markets because markets are driven by human beings. And what do we know about human beings? We know that sentiment and emotion always overshoots, meaning when times are good, we as humans extrapolate. That's what we do. They'll never be bad again. When times are bad, they'll never be good again. We extrapolate. So do markets. They run too high on the upside based on euphoria. They run too low based on desperation or despair, right? And that's because markets inherently are human driven. Now they're increasingly machine driven, but even those machines are subject to human programmers and greed and all that kind of stuff, right? It ends up working its way into the deal. So now that brings us to the question, are we in an AI bubble? Now, my answer might surprise you because at the offset, I'd look at it and say, yes, I do believe that we are. But in defense, you won't hear me say this very often, but in defense of Jim Cramer and his ilk, I will say that he does have a point. Jim's argument is, yeah, there's similarities, but no, this time it's different. This time is different. Now, I am continually amazed by Jim Cramer's lack of wisdom and how he seems impervious to learning lessons from history. But I actually agree with him here because I think it is different. And I'll tell you what the difference is. When the tech bubble existed, that was the internet being birthed, right? And none of us knew where that was going to go. AI, I mean, there were prognostications. Some of them were right, some of them were wrong, but nobody knew for sure where it was going to go. It was totally new. I remember thinking that nobody's ever going to actually buy things online, that people want to go to stores. How wrong was that, right? But here's to me is the biggest difference. And I've thought about this from the very beginning. AI is launching at a time where the internet is already in place. And because of that, we've got to be careful talking about bubbles. And it's one of the reasons that whenever I say I'm concerned, I always offer that caveat. Look, I don't think that the market's about ready to plummet. I don't think the bottom's about ready to fall out. And I don't think the market's going to go down 50%. And one of the reasons I say that is that this environment, for a variety of different reasons, and as a value guy, I hate admitting this, but I've got a commitment to the truth. In this environment, I think it's very fair to argue that you can sustain and justify higher valuations. Why? Because via the internet, companies are able to scale and expand so much faster, right? So think about like 40 years ago as a company. It didn't really matter what sector you were in or what you did. There were natural limitations, CapEx that was needed to expand a business, right? If you wanted to have a presence somewhere else, it had to be bricks and mortar, or it had to have infrastructure of some kind. And that's no longer the case. Palantir being a perfect example, right? They're a tech group based out of Palo Alto. They can deploy their tech at virtually no cost across the entire world, assuming they've got the compute, but they do. And conversely, we've seen it create these massive corporations that are huge, that are still growing at 30, 40, 50% a year. Why? Because they're able to deploy on a massive scale. And for that reason, I would posit that, yeah, the AI bubble or AI is not going to be bound by the same rules that the internet bubble was. Now, stay with me. Because the internet didn't have the internet, right? It wasn't able to scale as quickly. It wasn't globally proliferated at near the same rate that AI will be. Now, flipping back over, why do I think it's a bubble? Actually, I'll say this, and take this with a grain of salt, because obviously it's my opinion, but I feel very strongly about it. I know it's a bubble. And why do I know it's a bubble? Because this is a land race. Meaning some of these things in the bubble will ferret out and play out just like it did in the internet boom. There's a lot of these things that will go to zero. And when you look at the market caps that have been assigned to those things, that's why I say it's a bubble. Because you have the potential for a massive amount, trillions of dollars of capital to evaporate in a very short period of time when price and value collide. The other reason why I will say that is all the reasons when you look at we've never seen mega cap companies like this. We've never seen companies at the top of the S&P trading at 25 and 30 times sales. Okay. So my point is, if your argument is we're seeing things we've never seen before, these companies have abilities that no companies have had before, I agree with you. And that adjusts that commands a premium valuation. But at the same time, when I flip over and look at the market, I see things trading at valuations that we've never seen before. So this gets to my point. I agree with the reasons that the people that are saying it's not a bubble, I agree with their reasons as it relates to it not being the same as tech in 2000. I disagree with them saying it's not a bubble. And part of it goes back to large numbers. Just the law of large numbers. When you've got a company like NVIDIA that's doing 250 billion revenue a year, somewhere in that ballpark, trading at a $4.5 trillion valuation, 4.7 now, pushing to $5 trillion. Right? So let's say it's 200 billion. It's somewhere between 200, 250 billion, I believe. Let's say use a round number, easy math in my head. 200 billion. So that means you're trading about 25 times revenue. Crazy, right? For a company that large. So my point in saying that, what would it take for NVIDIA to really move the needle? Right? What would it take for NVIDIA to double? Do you think that it would be doubling revenue? So would $400 billion in annual revenue equate to $10 trillion market cap? I don't think so. I mean, that math doesn't math. More importantly, in my opinion, let's say you're just hoping to make 10% on NVIDIA. Well, that means the value of NVIDIA needs to go up $470 billion, which is over 2x their annual revenue. Will NVIDIA continue to grow their business? Yes. But what do you think NVIDIA can launch that will 2x their revenue over the next 5 to 6 years? As a matter of fact, if we step back and look at it and look at history, and hear the news coming out of China, I think if I was going to make an economic or stock-based bet right now that I felt like had the highest level of certainty, it would be this. It would be that NVIDIA 2 years from now, that their margins are statistically significantly lower than they are now. And I don't really think you need to be that much of a prognosticator to make that call. You're already seeing the signs. Like I said, China's saying they don't need the chips. That means that they have an alternative. And when you look at the price difference between the alternative and NVIDIA's chip, that provides a lot of room for people to rationalize that price difference, meaning there's a lot of things that you can do to deal with the less performance you're getting from the inferior chip. And so when I look at the AI space, generally speaking, I think it's going to be as big and important as so many people think. I just think there's going to be fewer winners. And I think that all of the AI exuberance is built into all these names. I think very few of them are going to realize the full fruit of that. And more importantly, I think the future looks really bright. I just think it's really hard to argue that stock prices don't more than reflect that. And there's always going to be exceptions, right? But I mean, you guys know I was pounding the table on Taiwan Semiconductor at $140. Today we're hitting 290. Love the company, but I'll tell you what, it's a heck of a lot less attractive here than it was when we bought it a year and a half ago. So I'm even looking at things in my own book going, The other thing that we've got to be prepared for is we still got to learn how to monetize AI. I mean, there's going to be subscription services and things like that, but there's work to do to get it to the level of, that's the other thing is we're so used to watching the tech companies, right? That unbelievable explosion in so many of these companies' earnings. I'm thinking of Google, I'm thinking of Apple, I'm thinking of Amazon and Meta and all that kind of stuff. Actually, let's exclude Apple from that different deal because they're primarily a hardware manufacturer. But looking to those other companies, remember, it wasn't just tech that made them all that money. It was really, a lot of it was social media based, meaning they took social media and created and turned it into the greatest curator of consumer information the world has ever seen. And the usefulness of that was so inherent and so obvious and so easy and so quickly grasped by so many people that you just had this incredible growth rate. Okay, I cannot help but to sit there and think that I do not think AI is going to be monetized as quickly as that. It's more complicated. You know what I mean? I think the internet is going to allow AI to be deployed much faster than the internet was. And I think you'll see the progression of it. But I don't think you're going to see the revenue and profit response that we saw from and think about it, right? The rise of Meta, the rise of Google, right? Microsoft, again, is a different animal. But the rise of those companies, which, between the two of them, Meta and Google, what are you talking about? You're talking about $4 to $5 trillion in combined market cap, pretty big movers in this cycle. The vast majority of that growth was built off cloud computing and advertisement, right? Online ads. And that was a slam dunk. I mean, that was a slam dunk that I wish I would have realized earlier because I wasn't on that trend nearly as hard as I should have been. But you flip over and look at AI, I just think it's going to be more complicated. Someone's going to like to, for instance, if you've ever used Facebook ads, they're incredibly effective for the price they cost. And anybody that uses them, that does it, that follows best practices and things like that, I haven't heard anybody disagree with that. It's incredible. Same with YouTube advertising through Google. It's incredible the way you can target audiences, the price effectiveness of it. It's like a self-proving thing. It's hard to be. I think AI is going to be much different. Look at the lackluster response to some of the AI stuff that Apple's tried to launch. It hasn't been good. I think some people hit it, some people won't. So I just think it's going to be different. And the thing that concerns me, why I believe it's a bubble and why I think it has to be a bubble, is because of the activity of the companies. Meaning, guys, one of the things driving these valuations is the unbelievable spend, and it's trillions of dollars. This will be the biggest CapEx cycle the world has ever seen. Okay, and they are throwing all that cash. And I'm telling you, I know the way these guys think. They know that the majority of things they're throwing this cash out are going to be zeros, right? They're taking a VC-like approach, a venture capitalist-like approach, which is we're going to spread the bets out far and wide because we know if we hit on one of these bets, it'll far more than compensate us for all the others. Okay, when you see a land grab like this at the beginning of a new technology, it's almost impossible that it doesn't turn into a bubble. Because these guys, because what AI is going to turn into, they've got to spend like they're spending. But that spend is going to drastically overinflate all the prices of anything tied to that sector. Think of it as like a mini market, but instead of the Fed pumping in money, you've got the big tech companies. The effect is going to be the exact same, and it has been. And so if you think about it in that context, of course it's a bubble. These guys are throwing money at things that they don't think will work, but they don't know. And a perfect example, and I was not well informed enough. Wasn't educated enough on it, but I wasn't the only one that turned a blind eye to companies like Amazon and Facebook. Social media, cool. Yeah, everybody wants to use it. How are you going to make money on that? And I remember one day it hit me. I was like, nobody has more consumer data than Facebook. And I went, oh my gosh, I missed that. Now, we've since made money on Facebook, but not where I would have liked to got it. If I would have understood what I understood now, I would have been long and you can't go back and redo things. But what I'm kicking myself for, and which I have determined that I will not repeat during the AI cycle, is just writing things off too quickly, especially things that are high priced. Because when you look, if I would have understood what Facebook was, I wouldn't have thought it was as overpriced as it looked on an ephemeral basis. Because truthfully, a lot of those times I was looking at it and thought it was overpriced. It wasn't even close. So they're like, well, Zach, how do you know that's not the case with AI? I don't. It could be. But the setup is very different, right? The prices have gone nuts in AI, primarily the excitement, exuberance, and the potential future is part of it. But the biggest driver, in my opinion, is this CapEx. Because if you want to make an investment in AI, you've got to climb over those guys. It's like a giant bidding war. So I don't see how it's possible that it's not a bubble. And like I said, the CapEx to me is the tell. The other part of it is it's got all the hallmarks, right? When I see a company like NVIDIA that's supposedly the darling of the AI boom and looking at their returns, I think that's a justified title, right? Again, I put them in the Palantir category. Insane, expensive, incredible company that does great things. Impressive things. But having said that, right, everything has limits. And it's the CapEx that I can't look back. Of course it's a bubble. These guys are all comfortable with that. They know that because they know who wins, who are the winners of the AI race are at the top of the heap. So they're fine losing on 9 out of 10 bets. So yes, of course it's overvalued. And what does that mean? It means that I think the vast majority of these stocks are going to go through a period of time where they deliver very, very bad returns. Maybe not huge losses, but just sideways and no growth for a long period of time, like that's happened in the past. And like I've said so many times in the past, I think the most pernicious part about this is that this same dynamic has opened up some of the greatest value opportunities I've ever seen. Now, this is where I want to transition. Let's talk about the antithesis of a bubble, right? A value stock. Now, when we're talking about value stocks, we've got to make some assumptions, okay? So for the sake of this argument, make these assumptions with me. And that is first and foremost that we're actually talking about a value stock, assuming that our research is correct and that the valuation that we see, and I'll give you a perfect example of this. We own a gold mining company that's performed quite well, like most of them have. And it's currently trading right around $1 billion market cap. And they've got some production coming on, but and this one's a little bit difficult because they're in pre-production on some of their biggest, what will be their biggest revenue producers. So when I look at where they're going to be at in a year versus their own projections, and then looking at their projections with a jaundiced eye and sitting there going, okay, what if they come up 10% short or 5% short here, or whatever? Maybe the grades don't end up quite as good as they are. You start doing that work and you sit there and go, okay, on a price to earnings ratio, if this company just continues to do what they're doing, this is a cheap stock compared to the overall market, like on a price to earnings, right? Looking at earnings, revenue, price to revenue, that kind of stuff. It's a cheap stock. But then you remember, wait a second, this is a gold company. So unlike a manufacturing company, like for instance, Apple, right? We buy these parts from different people, we assemble them into our product, and we sell it. Right? Meaning, other than our IP, our intellectual property, we're not really sitting on a big asset, right? The value that we have is taking these ingredients or parts and using our expertise to build a product that is desirable. Okay, and so seems natural that you'd price that on earnings, right? Well, remember, a gold company is a little bit different. That I-80 gold company that I was telling you, the market value is on a per earnings basis. They forget something. I-80 doesn't buy stuff from other people and put it together. They own the stuff that they sell. Now, when we do the work on them, and if we apply a gold price of about $2,400 an ounce, gold's currently trading at 39 and change. At $2,400 an ounce, their current gold reserves. Now, there's different categories of reserves. You know, reserves, for instance, proven reserves are effectively reserves. You know what grade they are. You know you can get them. You know how to process it. It's money in the bank. And then you've got inferred reserve. There's all these different classifications, okay? So you go through that. You assign a present value to it. You do the work on it. And again, I grew up in the mining industry. I've got an analyst on my team that's all he's ever done is work in the investment side of the mining industry. And so we've got expertise here, but you go do the work and you're sitting there going, okay, this company that's trading at $1 billion valuation, and we're pricing it on profit and revenue at $2,400 gold, the gold they've got in the ground is worth north of $40 billion. Now, that's a value stock. Right? That's a stock where you're looking now, because it's a value stock doesn't mean it's guaranteed winner, but that's a stock where you're looking at the current price. You're calculating revenue and profits based off price of gold and all that kind of stuff. And you're looking at it, and then you're like, oh yeah, there's also this asset that's worth over $40 billion that they own sitting in the ground. Then I look at $1 billion market cap and I go, assuming this company, assuming that the data, assuming they're not a fraud, and assuming the data I'm getting is real, over the long haul, it seems like it's going to be really tough to lose money in this. Now, again, we got to make the assumptions that we've done the right research, it's not fraudulent, all that kind of stuff. But this is why, and it's not just gold stocks. It's not just silver stocks. It's not some nat gas stocks. But I actually think the most pernicious part of this quote unquote AI bubble is what it's getting people to ignore. Meaning, no matter what you think about AI, you've got to admit it's a bit of a black box, and it's a really expensive black box. Then I go over here and look at these other things that are not black boxes, that are going to have revenue growth that is better than a lot of these AI companies, that have margins that are better than a lot of these AI companies. And oh, by the way, they're sitting on a massive freaking asset in the ground. That is a value stock. And I'm not saying one is better than the other because it's a value stock, you got to sell it. I mean, that doing analysis like that on non-technology stocks over the last 15 years, that's cost you money. But I just think you've gotten to a point where this has gotten so strung out on a valuation basis, and this is so cheap on a valuation basis that you're going to continue to see a forced migration into stocks like that. And so far, that's been the way this has played out. And I would guess that's probably how this AI bubble ends. Now, it'll reaccelerate like other bubbles, like when the winners become apparent and the tech becomes monetized. And like I said, I think all of that's going to happen faster than the internet because of the internet. But I think the biggest mistake investors are making is being blinded by all, because the party is already being had. Right? The people that are selling you this AI stuff right now, they're the ones that are booking the profits. They're the ones that are benefiting from it. They're the ones that are quote unquote killing it. You're paying these guys right now for what's going to happen over the next 5 years. That's why it's so expensive. And then I flip around and I look at these whole class of stocks that are going to show year-over-year revenue growth of 50% or greater, margins that look like insane tech companies, and they're trading at a massive discount to NAV, net asset value. You never know when the timing happens, guys, but there becomes a point where the valuation gaps get so large, you just got to say, hey, man, I go where the money is. At least that's my opinion. And here's the deal. We might be wrong. Okay, but when you follow those types of guidelines and those types of rules, what did we just say? And again, this isn't controversial. It's mathematical. If you want better returns over the long run, limit your losses in the bad markets. And not only do I think there's phenomenal investment opportunities on the value side of things, and gold companies and natural resource companies and oil and nat gas, and then and all kinds of companies that are international because they've been ignored too. It's that continuing to chase these AI type companies, that's how you end up getting 60 and 70% losses. And remember, guys, 70% loss, what do you need? 70%, you've got to do, that's like a 230% return to get back to even, something like that. People are like, what are you talking about? Well, because so you got $1 million, it's now worth 300,000, right? If you triple that, that's 900 grand. You're still 100 grand short. They go, well, that's 300 times. It's 300%. No. 200% is equivalent to 3x. So, but you need about 225% gain. You can be a really good trader. 225% usually takes a while to rack up. And so that's my whole point, is not that this AI stuff isn't going to work, not that it's not going to be extremely profitable, not that it's going to be really cool and do really cool things. I'm on board with all that. I just know it's a bubble. And if you listen to the CEOs talk, they'll acknowledge it. And it's a bubble because it has to be. They have to overpay. If they don't get their name, if they don't get their number on the right asset, they're out of the game. They're out of the race. So if you ask them, it's why Bezos says, yeah, the AI bubble's real. He knows what I know. He knows what we're talking about. Yeah, we are knowingly paying prices for things that we don't think will ever be worth that, but they might be. And the stakes are so big that we have to bet. Okay, I'll just tell you, that's not a table that normal people want to be at. And don't think about it as just you own the stock. Put yourself as an owner of a company, right? Unless you're one of those billionaire guys, you don't want to play at that stakes. Because remember, if a guy like Bezos takes a 50% hit to his net worth, he's still one of the wealthiest people in the world. You're not. They can afford to take these gambles. You can't. I can't. So proceed with caution, but always know, when you hear me saying this, I'm not poo-pooing these companies. I'm not saying you can't make money investing them. I'm not saying any of that. What I'm saying, it is, of course, it's a bubble. They'll tell you that. And I would expect it to be nothing less. Meaning when you see an opportunity, I understand why they're doing the CapEx. I don't disagree with it. I just think that CapEx is going to end up costing a lot of them very dearly, and valuations are going to pull back substantially when that gets realized. And I don't want to play at that table When I'm looking at this, I've got this smorgasbord of things that could not be more opposite. It's like in basketball, it's like in football. Hey, we're 3 yards out from the end zone. Our best play is a dive play right up the middle. Let's just do it and take easy money. No, man. I'm going to throw a back shoulder fade because I got a great arm. I want to impress the cheerleaders. I want to show the people in the stands. No. It doesn't matter how you get in the end zone. It's all worth 6 points. Take the easy route. Take the guaranteed route. Not guaranteed. Can't use that word in this business, but you guys know what I mean. Don't swing for the fences when all you need is a walk. And that's my whole point here. And like I said, I actually sit there and I look at a lot of these natural resource companies, and I think their upside over the next 2 to 3 years is infinitely better. I don't need them to go parabolic. I don't need them to be in a bubble. I need them to get back to a valuation that is somewhat representative of their assets and their cash flow. That is a much more reasonable ask for a company than to ask it to maintain 70% margins and 55% revenue growth as a mega cap. That ain't going to happen. Book it. Won't happen. So I'm not telling you to have exposure to this sector. I think you need to have I think you have to have exposure to the sector to some degree, but just be very choosy about how you do it, and do not ignore the rest of the stock market. I have been pounding the table on gold and silver stocks, saying, guys, I don't care what people say. Profits are what drive stock prices. And I was looking at it. GDX is up 127% year to date. And it is still dirt freaking cheap. And it was dirt cheap when it started. There are times when value is a little less out of favor and more in favor. There are very few times where you can buy $1 for 10 cents. And that's the case in so many of these different markets. And yet everybody is just myopically focused on this one. So is it a bubble? I think obviously it is. Do you still need to have some exposure to it? Yes, especially the parts that are not insanely expensive. Can you take some speculations in some of those plays? Yes. Should it make up 50 to 60% of your portfolio? No. And not because we know it's going to implode, but because we know that this rush, this land grab of sorts, has created generational buying opportunity. We've got layups. Take them. I was telling that my son plays quarterback, and he's got a freakishly good arm. Yeah, you ever see the movie Jerry Maguire? There's a scene at the end of the movie where the kid throws the ball back over the fence, and it's a great throw. And Jerry, he's a sports agent, and Jerry Maguire's looking at the kid, and he's like, holy smokes. And the mom's like, oh no, you're not, he was like that. I remember the first time I saw my thumb throw a baseball, I was like, and I don't have a special arm at all. I was like, geez. Well, he's in the 7th grade and he could throw a football 50 yards on target. But I was telling him, and because of that, he always wants to drive the ball downfield. And he's capable of hitting deep shots. He had two passes this last week and over 40 yards. But what I was telling him, I go, son, you don't know Tom Brady. You don't know who Tom Brady is. We don't call Tom Brady the GOAT because of the deep balls he threw to Randy Moss. We call Tom Brady the GOAT because he kept the chains moving. I think back to the Super Bowl that the Seattle Seahawks lost to him. Tom Brady beat them on 5-yard stops and 5-yard digs and 5-yard outs. Short stuff, because that was what they were giving up. And Brady had the patience and the discipline to stick with it. And it won him 6 Super Bowls. Investing's the same way, guys. We're going to be tempted to go for the deep ball. We're going to be tempted to try to make the money fast. I am just telling you, when somebody is selling $1 for 10 cents, buy it. If it drops to 8 cents, buy it. It is $1. And if you do that, you will have far greater success over the long run than buying $1 for $10, hoping it goes to 15. It's just the way of the world. Don't hate me, hate the game. Anyway, got to run. That's it for today. Don't miss us. We'll be back with the Daily Dots. Should be Chase and I both on Monday. We're also going to be dropping that interview with Tobias Carlisle on Monday. Don't miss the interview we just did with Rudy Havenstein. I'm going to post it on my Twitter as well. Just good stuff, especially if you don't like the Fed. And more importantly, if you want to understand the role that the Fed has played in all this, I think it's a great interview, and Rudy's always a blast to listen to and talk to. So anyway, have a wonderful weekend. We'll see you guys next week. You're listening to the Know Your Risk Podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.